Howdy, Jacob here. Today we're looking at Texas Pacific Land Corporation in the oil, gas, consumable fuels industry. 13.7 market cap, just under 13 billion enterprise value. Looks like they engage in land and resource management, water services, and operations business. Okay, company has a very high return on invested capital, very little return on equity. Makes sense due to their enterprise value being lower. They likely have very little debt here. Operating margins are bewilderingly high, decreasing, however. But I mean, you still got 77 operating margin. That's like the gross margin of Adobe or something. So insane margins there. Growth was very high 2 years post COVID, and then it actually decreased a little bit recently. Earnings per share astronomical in the 50s. Dividends been growing even greater. Balance sheet shows 725 million cash on hand, 113 total liabilities. Very safe from a balance sheet perspective. That is a huge positive. Capital expenditures are very low. They are well above what they were 10 years ago, but cash from operations are even greater, 10 times greater than they were from 10 years ago. And so cash from operations is much greater. Intangibles, so a little bit of reinvestment there. The dividend of 100 million in aggregate is probably like 33% of their 5-year free cash flow. Their repurchasing of shares is even less, maybe 15 to 20% of free cash flow. And it looks like they're just increasing their cash. Yeah, so 13 million in cash up to 725. I mean, that's good that their balance sheet is so healthy, but if a company is just accumulating cash, you have to think that that's money that they could be doing other stuff with. So if they're cash and cash equivalent, they're just investing in bonds. You're just getting a 3% return on that money, or 5% right now. Historically, about 3%. That's not a great investment. If a company can find a better way to invest, then they should absolutely do that. If they're paying a dividend will get you 8 to 10% if you're either reinvesting on average or just take it out and invest in the market or such. Buying back shares can be a fantastic opportunity if your stock is stupidly cheap. I think their capital allocation here is a little bit poor. We are seeing just great appreciation of their cash balance sheet, but again, unless we don't know something that maybe they're trying to save up for an acquisition, so they don't have to go into debt for it. That could be possibly a good use of cash. But I think to me, I'd want this company to be giving me the money back in a dividend or buying back shares that are obviously cheap. And so I think I will be, I'm just pointing out, I think that there's a little bit poor capital allocation going on, but we can still make assumptions here. So let's start with that. Revenue side, we did see slight decrease post COVID for the crazy 2 years right there, but I still think that there is a good amount of growth here. Founded in 1888, that is insane. They produce water royalties. Oh, royalties, that's why they're so high. So if you did more research, you definitely want to see when these royalties end, because sometimes I think I looked at a company like Innova in Innoviva maybe. It was a royalty pharmaceutical company, and it looked extremely cheap, high level. You just saw 7p or so, but then you see that in 2 or 3 years the royalties end and the margins fall from 80% to 15% or 20%. So big hit there. So you definitely want to look at that for a business like this. It's probably why we're seeing slightly decreased margins. Maybe throughout time, some of their royalties are going away, and they're going from those 90% margins, no reinvestment, to 20%. But definitely something I'd look at with more research. But for now, let's say that revenues grow 5% maybe, and then 15 on the P price to free cash flow. Net income margin has been going down a little bit, so maybe let's do 55 and 50. No share change. I wonder where that is. Okay, so 1% of shares buying would be about 136, 137 million, and they're not doing close to that. So that's probably why. So let's say they use 70 million to buy back shares. I think that seems pretty reasonable to me. And then the dividend at 0.81% and is just 30% of their 5-year average free cash flow. I think they're able to increase that pretty substantially. Let's increase that maybe 8% every year. Okay, so with these assumptions, I have put a fairly decreased margin in compared to the history, but we are seeing declining margins. And what we know about royalty deals is that there is an end to them, and then afterwards, margins are absolutely largely hit. It's the same with when you own a trademark or copyright on a pharmaceutical drug, to where for the next 10 years you can throw it as high as you want, and then it becomes generic and margins are falling pretty quick. And so that's similar to what we're seeing here. That's what I'm presuming, and I think I'm pretty comfortable with these assumptions. And right now it just looks a bit on the expensive side for me, but like I said, pretty good business. I would just be interested in when those royalties end, but these are huge margins everywhere. I think it is a great business, very little or no debt, huge amount of cash on hand. I just want this company to better allocate their capital, in my perspective. So hopefully you enjoyed the video and have a great rest of your day. Thank you.